Hi everyone, we are now going to look at Chapter 9, Part 1. Part 1, we are going to deal with accounts receivables. So let's take a look. We are going to be describing accounts receivables and how they occur and are recorded. If you're saying, we already did that, you're right, but we're going to look at it again. We're going to explain how receivables can be converted to cash before they mature. Now that deals more with our part 2, but it also can apply to accounts receivables. So we can get our money early. We're going to look at what's called the direct write-off method of accounts receivables, the allowance method, and we're going to show you how we estimate for uncollectible accounts based on sales and accounts receivables. So that'll all make more sense as we proceed. So first of all, what is accounts receivables and how do they occur and are recorded? Well, we know from our prior chapters that receivables are amounts that are due from another party. Now in this chapter, we break receivables down between accounts receivables and notes receivables. So we are going to deal with accounts receivables. These are amounts that are usually due to us because customers purchased from us and they owed us money. So these are where whenever the company makes a sale to a customer and the customer doesn't pay, we track the amount they owe in this account. Now, how do they occur? We'll take a look at an example. July 1, TechCom had credit sales of $950 to CompStore and a collection of $720 from RDA Electronics from a prior credit sale. So the day they sell to CompStore on account, on credit, they debit accounts receivable and credit sales or sales revenue. When they receive cash on account or from a prior credit sale, they'll debit cash for the dollar amount and credit accounts receivables. So you can see we're not showing the cash we're receiving as a sale again. No, we're just receiving payments on amounts from accounts receivables that have already been recorded as sales. Now, we post these transactions to our general ledger accounts just like we do any other journal entry. So you can see here that in the general ledger, accounts receivable on the left, okay, there's a dollar amount of $950 on the debit column and a $700.20 credit in the, of course, credit column of the general ledger. If you're going, well, what's that thing on the right? Well, in our general ledger, it just says accounts receivables, and we call that a control account. So it's a very high level account, meaning it's just telling us totals. It doesn't tell us who owes that money. We actually use what's called an accounts receivable subsidiary ledger, a subledger, a second ledger. So this is its own separate ledger, but it's where we store all of our customers' names or accounts. And anytime we sell to a specific customer on credit or on account, you can see there in CompStore's accounts receivable account, there's a debit, $950. So not only do we change the general ledger account, we have to change this subsidiary listing for that specific customer's account. When a customer pays on their account, like RDA did, you'll see that $720 credit. So we're keeping a running balance of each customer who owes us money in this subsidiary ledger. If we add up all the amounts the customers owe us in the subsidiary ledger, it will equal our balance in the general ledger. So it's like a ledger off to the side that's tracking one account in our general ledger. It's giving us specific information about it. Now, on November 1st, TechCom recorded sales on their own credit card in the amount of $1,000. Okay. So they're debiting accounts receivable and crediting sales. Okay. So this is a store credit card. Techcom has like you have a Macy's card or a JCPenney's card. Well, Techcom has a Techcom card. Okay. So any sale on account or on this card, they're not going to receive that money. It's not a Visa card or a MasterCard. It is a credit card they extend to their customers. A MasterCard or a Visa through a bank is different. In that case, Techcom would receive their money within 2 or 3 days because it's the bank that will pay Techcom on those credit card sales. Then the bank who sponsors the credit card collects the money from their customer who used the credit card. That's not what's happening here. Here, Techcom is giving out their own credit card and saying, pay us in 30 days. So Techcom won't receive the cash from the customer until the customer pays on their credit card. So that's why we're debiting accounts receivable and crediting sales. Techcom at the end of the month will record interest earned on this credit card because most credit cards have interest. How much? 1.5% per month. So usually interest rates are stated as an annual percentage, 12%. That means that interest rate is for a full year. So if it doesn't say per month, the assumption is that's the interest rate for 12 months. But since this says, oh no, this is the interest rate for 1 month, we calculate interest by taking the amount of the principal. In this case, it would be $1,000 times the interest rate times time. That's our normal formula. What your author did here was they already created or took the interest rate times time and found a 1.5% interest rate. So you don't need to do that part. You just take the $1,000 times 1.5%. How much does the company earn on this credit card? $15. So each month they're going to take the balance of their customer's credit card times 1.5% because that is a monthly interest rate and record it as revenue, crediting interest revenue, debiting accounts receivables. So that's when the store has their own credit card. When it's a bank credit card, like I was just talking about, what if, it's a Bank of America Visa card that your customer is using? Well, that's different because it's Bank of America who has the credit card with your customer. You're just accepting the Bank of America credit card to pay for that purchase. The money from that sale will be forwarded to Techcom pretty quickly, 2 days maybe, 3 days. But here's the deal. When Techcom makes that sale, they have sales of $100. But they're charged by Bank of America a fee because they accepted that credit card. And in this case, Bank of America is charging Techcom 4%. That's why if you ever go to the gas station and it says if you use a credit card, you got to pay this per gallon, but if you pay in cash, you're paying less. That's because the gas station is passing the fee of using your credit card onto you, the consumer. But in this case, Techcom is not doing that. They're paying the 4%. So they get a credit card expense. They debit that. That's an expense of them taking credit cards, and they're okay with that. It's usually 4% of the amount that was charged. In this case, 100 times 4%. So how much will Techcom actually get in their checking account? $96. And why do companies do this? Well, do you want the sale or don't you? Right? Sales on installment. These are amounts owed by customers from credit sales. Okay, so the company sells on account to a customer for which payment is required in installments or over time. It's not all due in 30 days. Maybe they'll say, pay us $100, you bought off of us $1,000 worth of stuff. Pay $100 at the end of month one, $100 at the end of month two, $100 at the end of month three. Now you're drawing out the time you're going to be receiving your money back. When that happens, the seller will usually charge interest. And it's just a way of making money. Now, people will say to me, what about these furniture stores that they'll say, oh, 0% interest for 3 years. You don't pay any interest on this purchase for 3 years. Well, walk into that store, have one of your friends go in and say, oh yeah, I want to take advantage of your 0% interest. See how much they charge you for that furniture. You walk in and say, I have cash. I'll pay you cash today. Watch the price of that furniture go down. So you're never in a situation where it's 0% interest. They're just charging you more for the furniture. All right. So we saw our different ways that we create credit sales, whether it be, on account, a store credit card, and then we saw what happens when it's a bank credit card being used. And then we talked about installment sales. Now, the number one problem with accounts receivables is that people don't pay their bills. So usually, before we even extend credit to someone, we do a credit check. We want to make sure they're going to pay their bill. We want to feel comfortable selling to them and waiting for our payment in the future. If we're not going to sell to them on credit, right? But even when we feel comfortable selling to someone on credit, something could happen to them between the time the sale occurs and they owe us the money. Bad things happen to good people and bad things happen to good companies. The person could die. The owner of the business could die. There's no guarantee we're going to get our money. Maybe the company that we're dealing with that we sold to on account, one of their customers went bankrupt and they're not getting any money, so we're not going to get any money. Maybe one of our customers who isn't a business, maybe they lost their job or came down with a major illness. So things happen. It's the real world. We can't expect to collect all of our money all the time. So how do we handle that? Well, there's two methods of handling what we call bad debts, because that's what those items are called that we can't collect on our accounts receivables. And the first is called the direct write-off method. Now we're going to talk about it, but you usually don't use it in this type of class for creating financial statements. You usually use it on the tax return. So some customers may not pay their bill. Uncollectible accounts are referred to as bad debts, and there are two methods of accounting for bad debts. Direct write-off is the method we're going to tell you about, but we don't use it for financial statements normally. The method we do use is called the allowance method. So let's look at both. The direct write-off method says this: wait till an account actually becomes uncollectible. The customer goes bankrupt. You haven't received a payment in a year. Okay, there's going to be signs out there that says you're not getting this money. They disappeared. You can't get in touch with them. It's on that day you will debit an account called bad debt expense, which is a new expense, and credit your asset accounts receivable. So here, TechCom determines on January 23rd that it cannot collect $520 owed to it by its customer, J. Kent. There's the journal entry. Note that the specific customer is noted in the transaction, so we could also take the amount out of the subsidiary ledger for that customer. What happens if Kent says, oh, I'm sorry, I forgot I owed you this money. Here's all your money back. on a couple months later. We don't go, oh no, you don't want to pay us. We already wrote your account off. No, we want our money. So we go through a two-step process. The first is we reinstate Kent's account. So we reverse what we did when we wrote off his account. We debit accounts receivable and credit bad debt expense. And then we debit cash and credit accounts receivable. Now, if you're sitting there saying, oh, I could see an easier way of doing this. Yes, you can, but that's not what you do. Okay? You have to do this two-step process. Now, why don't we use it normally? Expense recognition principle. This was back in chapter 1. We also call it the matching principle. It requires an expense that is caused by a sale. So an expense that's the direct result of a revenue. The revenue caused the expense. It requires the expense and the revenue to be reported in the same accounting year. If you sold everything for cash, you wouldn't have bad debt expense, right? So sales on credit cause bad debt expense. There's no guarantee under the direct write-off method you are going to record bad debt expense for all the sales on account you don't collect in that same year. So you can have a sale in 1 year when you report the income, and then the bad debt happens next year. Well, under the direct write-off method, it says record the bad debt expense next year. Well, that violates this principle. That's why we don't use it. Now, if there isn't a huge dollar amount involved with bad debt expense, okay, we say if it's not material, it's okay to use it for financial statements. But most companies use this next method, and it's called the allowance method. Now, what is the allowance method? It keeps us in conformity to the matching principle. Well, what does that mean? This method says you had sales on account or credit sales this year. You know everybody's not going to pay their bill. Don't wait until next year when they actually don't pay their bill to debit bad debt expense. Nope. What we're going to do is at the end of this year, we're going to try to estimate the dollar amount we probably won't receive next year. So we're going to try to estimate future bad debts next year. Record them as bad debt expense this year. And that's what keeps us in line with the matching principle. What does it accomplish? We record bad debt expense the same year as the sale. Even though it's an estimate, that's okay. Something's better than nothing. If we use the direct write-off method, there's nothing being reported this year. Nope, you've got to estimate it. It also helps our accounts receivables to be reported at a more accurate balance, and you'll see what we're talking about. So there's two different ways of estimating for bad debt expense. The first is called the percentage of net credit sales. And here's what we do. We take net credit sales for the year times some percentage normally or determine some dollar amount that won't be collected in the future of our net sales. So say here, TechCom had credit sales of $300,000 during its first year of operations. So they sold on account $300,000. By the end of the year, $20,000 is still remaining in accounts receivables. Based on experience of similar business, because remember, this is their first year, TechCom says, what's our competition usually don't collect? And they came up with, and based on their own sales and the experience of their competitors, they figured about $1,500 of its accounts receivables won't be collected. Okay, so here they're using their accounts receivables. We're also going to see when they use their sales. So they said, we're not going to collect about $1,500 of that 20 grand. Since this is their first year, They've never done this process before, so everything's zero balances. What will they do? And this is an adjusting journal entry that is done whenever you're going to do a financial statement. So this could have been shown to you in Chapter 3. Debit bad debt expense, $1,500, and we credit a contra account to accounts receivables. There's another one, right? A contra account. We credit it because it's a contra asset to accounts receivable, so it increases on the credit side. And we store the estimate of what we don't expect to collect in this account called allowance for doubtful accounts. So it's the allowance method, allowance for accounts we probably won't collect. So we credit this account when we estimate. Okay? And we debit bad debt expense. There we go. We got some bad debt expense recorded. Now look what happens on our financial statements. When we do our balance sheet, remember before we put accounts receivables, $20,000. Not anymore. Now we're going to put accounts receivable less that contra account, allowance for doubtful accounts, $1,500. And this is what I was talking about a few seconds ago. Here we're showing, hey, we are owed 20 grand. That's what we're legally entitled to. But we know, based on our industry and based on, history, people probably, we're guesstimating that about $1,500 of that will not be paid to us. So what's our reality? We call that net realizable value. What do we actually think we're going to collect? The difference, $18,500. And you could see there's two different ways of presenting this information on your balance sheet. You pick the method that you like. Okay. So now what happens when an account actually does become bad? We just looked at estimating. At the end of the year, or whenever you're going to do a financial statement, get some estimate in there so you have some bad debt expense recorded for that year. What happens when an account actually does become bad? Like Kent's. And that's reversed. That should say 520 in the example. So TechCom has determined that J. Kent's $520 account is uncollectible. We don't debit bad debt expense. We already did that when we estimated for bad debt expense. Instead, we debit the contra account. So whenever we have an actual bad debt, reduce the allowance account for the actual. So we have estimate on the credit side, actual on the debit side. And if we're really, really good at estimating, they'll equal out at the end of the year. But that never happens because nobody's perfect at estimating. But we debit the allowance for doubtful accounts, then credit accounts receivable. And you could see what happens here. Accounts receivables goes down and the allowance account goes down. Over in the credit side, we have our $1,500 estimate. That's how much we expect not to collect. Well, so far, 520 actually became a bad debt. Okay, so we're just showing you the write-off doesn't affect the net realizable value of accounts receivables. Before it was $20,000 in accounts receivables minus the allowance for doubtful accounts is $18,500. After the write-off, the new balance in accounts receivables, $19,480 because we reduced that account, but we also reduced the allowance for doubtful accounts. So the net realizable value overall will be the same amount. What happens if Kent does pay his account? Remember, the direct write-off method was one way, but you still had a two-step process. This is a little different. Remember, when we wrote off Kent's account, we debited the allowance for doubtful accounts, credited accounts receivable. So the first thing you want to do is reverse the effect of the write-off. So you want to reinstate Kent's accounts receivable by debiting accounts receivable and crediting allowance for doubtful accounts. You're putting that estimate back where it belongs because that account is no longer an actual bad account. Then you'll debit cash and credit accounts receivables for the collection of the cash. So just like I said before, you might see an easier way of doing this, and so do I, but you want to do this two-step process. Okay, so that's an overview of we need to make an estimate, the journal entry that needs to be created when we make an estimate at the end of the year, what happens when an account actually becomes a bad debt, and what happens if that account we recorded as a bad debt, actually we collect the money. So now we're going to look at the specific ways of estimating. And I mentioned before, you can use sales to estimate your bad debts, or you could use accounts receivables. So, and I mentioned this, the percent of sales method is a real easy method. And you just calculate it and plop the numbers in your journal entry, debit bad debt expense, credit your allowance for doubtful accounts, and you're on your way. But it's not an accurate method for calculating the amount of bad debt expense. What is an accurate method is using accounts receivables. Okay, but it's a little bit more involved, and that's what makes it a little more complex. So we're going to take a look at both. Remember, what are we trying to decide? How much we have to debit bad debt expense for and credit the allowance for doubtful accounts when we're estimating. So it's pretty straightforward, the percent of sales method. Take your credit sales for the period, multiply it by a bad debt percentage. Now, where does that percentage come from? It comes from you, the company. You're going to look at your past history. If you are an active company who has a history that you could rely on it, you're going to look at what actually went bad, how much were my sales for that particular year, and come up with a percentage. Okay, it has to be rational. It has to be supported with computation and pass the sniff test of an auditor. So every company is going to be different here. When you multiply that percentage by your current period sales, your credit sales, you will get an estimated bad debt expense for that time period. Now, that percentage could change from year to year to year. You're not locked in, so you don't have to use the same percentage each year because you're going to see, you're estimating. So your estimating may be off. You may overestimate one year, underestimate the other year. So you're always adjusting that percentage so that you're never having too much money in that allowance for doubtful accounts. So take a look. Musicland has credit sales of $400,000 in 2017. It is estimated that 0.6%, so that's 0.006, of credit sales will eventually prove uncollectible. So they'll take the 400,000 of credit sales times 0.6%. So they determine $2,400 is their estimate of future bad debts. They debit bad debt expense on December 31st, 2017, credit the allowance for doubtful accounts. Like I said, it's pretty straightforward. You're going to take your credit sales times the percentage, so you would be given this in all your homework and on the tests, and then debit bad debt expense for that result, increase your allowance for doubtful accounts. Okay, so the other method is using accounts receivables to determine bad debts. Now, when you use accounts receivables to estimate, you're not determining how much to put into the journal entry. What you are computing is what the new balance should be in the allowance for doubtful accounts. So you could see that second line there. It says compute the estimate of the allowance for doubtful accounts. So what we do is we take, and we're going to see two different ways of using accounts receivables. We could just say, what's the balance in accounts receivables at the end of the year? What's the bad debt percentage? How much of all of our receivables usually become a bad debt each year? You'd be given that percentage because the company figures that out. So what you just figured out is what the new balance needs to be at the end of the year as a credit in your allowance for doubtful accounts. So you're going to take that estimate, You're either going to add or subtract your previous balance in your allowance account. So you're focused on, what do I have to do to the allowance account to get it to the new balance? And that's the dollar amount of your journal entry, and whether it's on the debit or credit side. You would do the opposite to bad debt expense. Let's take a look. Whoa, that's small. Musicland has $50,000 in accounts receivables. At the end of the year, they have a $200 credit balance in the allowance for doubtful accounts. Now, before we go further, think about this. It's the end of 2018. So at the end of 2017, Musicland estimated for bad debts, just like we're about to do. They credited the allowance for doubtful accounts. Throughout the year, if you see that, you see it says, oh, I'm sorry, we're at 2019. Okay, so 2018, I said 17, it should be 18. They estimated that $2,200 of their accounts receivables would become bad accounts during 2019. So that was already there. During 2019, $2,000 did actually become bad accounts. There was one on July 10th. You could see the debit of $1,500 in the allowance for doubtful accounts, and then the November 20th debit of $500. So $2,200 didn't go bad, only $2,000. So at the end of the year, there's a $200 credit balance. So we overestimated. It happens. So this account does not need to be zero. What we do then is we go, okay, how much is our estimate for 2019? This company uses accounts receivables, which has a $50,000 balance, 5%. So they take 5% of $50,000, $2,500 is their estimate. That needs to be the balance, the ending credit balance in the allowance for doubtful accounts. So how do we get it there? We have to increase it $2,300. How do we increase the allowance for doubtful accounts? Credit it, but just for $2,300. When we add that $2,300 to the $200 that's already there, it'll get us to our $2,500 credit balance. Since we're crediting the allowance for doubtful accounts, we do the opposite to bad debt expense. Debit that for $2,300. And that's how we proceed with estimating when we use receivables as our estimator. We use sales, we go sales times our percent, that's how much our journal entry is. But since we're using receivables, we're actually calculating what the new balance should be in our allowance for doubtful accounts, where we store our estimate. Now, some companies take it one step further and they go, we want to be as accurate as we can with our estimating. So we're going to use what's called an aging of accounts receivables. So this is in your book. I don't have the book in front of me, but it's a report of your accounts receivable balance, and it'll list all your customers and how much they owe you. And further, it will then break the age, or break your invoices down by the age of the invoice. And it all depends on how the company ages its invoice, and we'll take a look at that. We get a total for each age group, and then we calculate bad debts based on these various age groups. Let's take a look. So here's Musicland. This is an aging of accounts receivables. So you can see all the customers are there and the total amounts they owe. So Carly Abbott, it looks like, it says, okay, sometimes these reports will say how many days have passed, or the age range from the date of the sale to the date of this report. This one is saying, okay, the first age group, none of these are even due yet. Okay, so any balance in this column, they're not even due. The next column will list those that are 1 to 30 days past due. Okay, so it'll list all the dollar amounts for each customer that their invoices are between 1 to 30 days past their due date. The next is 31 to 60 days past the due date. 61 to 90 days past the due date. And this is all as of December 31st. And then the last one shows those that are over 90 days past due. As invoices get older and older and older, it's less likely we're going to collect them. We're trying to, for whatever reason, we're not getting our money. So what we do is we determine what's the total amount of each of these age groups. Well, of the $50,000 that is owed to Musicland, $37,000 isn't even due yet. $6,500 of it is 1 to 30 days past due. $3,700 is 31 to 60 days past due, and you could see the two remaining columns. What we do is we look at the first age group and we go, what percentage of that won't we collect? And this is based on past experience. So the company determines this, you would be given this. In our example, the company determined 2% of that $37,000 won't be collected, or $740. Of the $6,500 in the next age group, 5% of that, or $325. Of the $3,700, 10%, or $370. Of the $1,900, 25%, or $475, and then of the last group, 40%, or $360. So now we're basing our estimate not on an overall total of everything that's owed to us, but by the time range it is actually owed to us. So we're getting a more accurate estimate. We're getting as close as we can to a good estimate. So we add all those totals, those amounts we just calculated in each age group. So what we're saying here is that based on using the aging report, we determined $2,270 of accounts receivables of the 50 will not be collected in the future. Using our example, now look at our journal entry. If we had the same allowance for doubtful accounts balance, that $200 on the credit side, we would need to increase the $2,070 to $2,270, debit bad debt expense. What if instead the allowance for doubtful accounts balance was a $500 debit? Now remember, on the credit side is where you stored all your estimate. On the debit side is where you will put all the actual bad debts. So if you end up with a debit balance in that account, you underestimated the amount of allowance for doubtful accounts last year. It happens. So what happens this year? Well, we need that allowance for doubtful accounts to be at $2,270. So we will credit the allowance for doubtful accounts, $2,770. Even more than we came up with in our estimate, right? And debit bad debt expense. And it makes up for that $500 difference. So here's a great summary of the methods we just looked at. When it comes to using sales, we call that our income statement focus. Why? Because we go sales times a rate, that's how much we debit bad debt expense. So we're focused on getting a good number in bad debt expense, or a good estimate based on sales. When we use accounts receivables, whether it be just a percent of the total or the aging, now we're looking at recording a good net realizable value of our accounts receivables. We're saying, here's the balance of our accounts receivables. Here's the dollar amount we don't expect to collect, and that's what our estimating forces us to do. So we're showing what the balance should be in that allowance for doubtful accounts when we estimate. So our focus is more on the balance sheet. So no matter which method you use of estimating, okay, you will always make sure you increase that allowance for doubtful accounts and do the opposite, whatever it may be, usually debiting bad debt expense. You will always write off your accounts in the same manner. You'll debit the allowance for doubtful accounts and credit accounts receivables, and you'll reinstate, because the allowance method is the same whether you estimate using sales or accounts receivables. So that's the hunk of our chapter here. That's the meat and potatoes. How we estimate for bad accounts and record the net realizable value on the balance sheet and make sure we have a bad debt expense recorded for the time period. So we properly match expense with the sales that caused it. The final part, I think it's a little complex for you guys, but that's okay. We could take a look at it. Sometimes receivables can be converted to cash before they're even due or mature. Companies will sometimes sell their accounts receivables. Banks and factoring companies, these are special companies that specialize in purchasing companies' receivables. Okay, so they could outright sell. So a company could say, I want to sell all my accounts receivables to this factoring company. Usually when they sell them, they no longer own them, of course, and sometimes they may or may not be responsible for them. So when you sell accounts receivables, you credit your accounts receivables. They're no longer on your records. Somebody else owns them. You're usually charged a fee. In this case, this company was charged a 4% fee to sell their accounts receivables. It's called a factoring fee. Debit that for $800. So how much money did the company actually get of the 20 grand? $19,200. So sometimes companies who need cash quickly will sell their accounts receivables, even though they have to pay a little bit of money to do it. They need that cash, so they'll factor them or sell them. The bottom one relates to when a company uses their receivables as collateral. So some banks will say, yeah, we'll loan you this money, but we need collateral. So the company will say, oh, we'll use our accounts receivables as collateral. If we don't pay our bill back, you could have the money from them. And that's allowed. In that case, you're not selling your accounts receivables. They're still there. So all you're doing is borrowing money. And that's what that journal entry at the bottom reflects. This company bought borrowed $35,000 in cash, debit cash, credit notes payable. Nothing, you still own the accounts receivable company, you're still going to collect on them. Okay, so I know that says the end of chapter 9, but that's the end of chapter 9, part 1. So please post any questions you may have to the discussion board.